Let's take a look at the overall environment over in Nigeria right now and the kind of sentiment that's floating around, because we've had the postponement of national elections unnerving investors, and that's certainly being felt on the Naira front. Also, some pressure being exerted on the country's $500 million euro bond. Equity impact that we're seeing?
Well, to be honest, Alishia, we have seen the impact more muted than at first feared. I mean, our initial thought was, okay, there'll either be significantly lower volumes and just a kind of remaining on the sidelines, or there'll be a big sell-off. And it's more been the former than the latter. For investors that we have spoken to during the course of yesterday, their general feeling is that, you know, okay, it's not great that the elections were delayed, but it's better to delay them and have something credible rather than sort of push them through and then the whole thing is a bit of a farce and we end up, you know, arguing in court for months and months and months, you know, after the event. So I feel that the tone from investors is generally constructive, even though they acknowledge that the situation is not ideal.
Let's take a look at some of the results that have been filtering through, because within this context, we've got those earnings reports keeping the markets ticking, and Diamond Bank, as I mentioned a short while ago, really coming as a disappointment to the market.
Yes, absolutely. It was a disappointment to us, and those that are, you know, have been following our views will know that Diamond Bank has been, you know, one of our top picks for the past 6 months. And, you know, we have to say that the underlying business, we are still, you know, there still seems to be good momentum there. You know, net interest margins of 10.1% is best in the sector by some margin. But, you know, of course, the big issue was the complete lack of expectations management with respect to the provisioning. And then, you know, the need to really get some colour from management on, you know, why they took 11 billion in Q4, you know, what we can expect going forward. Now, our expectation is that there's a little bit of a window of opportunity for management on the conference call this week because, you know, of course, we have a new MD, we have a new FD. You know, what we really need is convincing, clear, simple explanations as to what happened and what we can expect going forward. And I think that the fact that they have combined their full-year conference call with the release of Q1 results, there's potentially an opportunity for some good news there. You know, the FD mentioned indeed on CNBC that they intended to sell loans to AMCON, and that when they were done with that, their NPL levels would be down to 8.1% rather than 14.8% where they closed the year, you know, December 2010. So, you know, if this kind of flow comes through and then people sort of get a clearer understanding of what's happened, then that may well stem the decline of the stock. Although, you know, certainly from conversations that we have had thus far, investors are either wanting to sell out or at least wait until the conference call before they think about you know, coming in at attractive levels. And we have to say that at 0.7 times book, it is relatively cheap right now.
What are you making of the bank's plans to increase its traction in the retail business specifically?
Well, I mean, this is one of the bright spots in the business. You know, we are sure that it is what has helped the net interest margins to a sector-leading 10.1%. Their deposit base is now 75% current and savings accounts, which is, you know, significantly better than, you know, than Tier 1. I mean, GTB is like 39% retail or so, and many other second-tier banks cannot boast of such a strong mix of cheap deposits. So, you know, that is partly driven by the focus on the retail customer. Now, the idea, of course, is that you then translate that into lending to higher margin second-tier and SME customers, as well as to the retail segment, and you get the benefit on both sides. Now, the doubt that we have in our minds right now is what is happening with that second-tier corporate customer, given the level of provisioning that we're seeing, and that's what we really need to get the explanations on from management, you know, this Thursday.
Well, let's take a look at outside of the banking arena, because while we have had these numbers filtered through hard and fast out of the banking sector specifically, we've had quite a few others stealing attention, and amongst those, Wapco also disappointing and coming into the downside of your expectations, Rele.
Yes. Well, yes, we still have a buy recommendation on Wapco, and we are still satisfied with the underlying business trend. However, you know, they also took some provisioning in the fourth quarter, which we've yet to get full colour on from management, which caused their PBT to be significantly below our expectations. PAT was, you know, slightly, the effect on PAT was slightly mitigated by a lower effective tax rate, but the bottom line was there was, you know, again, unexpected provisioning in Q4 that caused them to come in below expectations. I mean, interestingly, we have not seen the kind of sell-off in Wapco that we have seen in Diamond Bank. So it's kind of they've sort of weathered the storm thus far much more in a much more robust manner than Diamond Bank has. But nevertheless, we were disappointed with the results.
There are risks to that picture, though, and key risk to that valuation on Wapco, I remember you mentioning at the start of the year, includes further delays on the commissioning of new capacity. To what extent do you see that a risk coming to bear on this company?
Well, as I say, we are not as concerned about the underlying operationals. It's really a case of the guidance from management on these unexpected provisions. We're not entirely clear. We've had a conversation with management that has guided us in this regard, that there was a provision. But in terms of the underlying reasons why we like the sector, capacity and efficiencies and operating efficiencies, we're still comfortable with momentum in that regard, which is why we have maintained our recommendation and our target price. But again, we just need to be comfortable.
Really, at their operating environment, there were concerns around the disruption in fuel supply in the country as a whole and the kind of impact this had on producers like Wapco. What's the status in that regard?
Well, again, I think that part of our positive sentiment towards all of the cement producers has been because they have demonstrated greater flexibility with regard to fuel and are not necessarily dependent on a particular source. We're seeing a greater mix of coal and gas coming into play as opposed to just low poor fuel oil. This operating flexibility has given us confidence over the medium term with respect to their performance. So that really isn't our most pressing concern. Our most pressing concern is really just getting clarity on this unexpected provisioning that was taken in Q4.
Really, throwing forward to the rest of the week, we're anticipating numbers out of DCP as well. Run us through your expectations there.
Well, we are expecting a strong performance from DCP. We expect EPS of 6.80 Naira, which is an improvement of 65% versus the prior year. And again, it's the same story. It is, operating efficiencies. It is reductions in fuel costs. It is a significant drop in selling and general administrative expenses. And of course, going forward for DCP, we expect this to be underpinned by production capacity coming on stream, during the course of 2011, and their general strength and dominance in the sector, gaining momentum, going forward. So we expect that for DCP, the results will be strong, and that we see scope for strong results to be sustained over the medium term for this name.
What are prospects for UBA back into the banking arena looking like as well? Because that is the big one out of the banking space that's being anticipated as well.
Yes, we are, we're not so enthused by the numbers that we expect to come out of UBA. The thing with UBA right now is that, it has sold off pretty aggressively, and the pricing, I think, is beginning to perhaps look interesting for investors, because we are seeing some interest in the stock, but its price to book is like, 1x, which is almost, compared to its peer group, which has an average of 1.4, it looks cheap. But, ROEs, we're expecting 5%. We're expecting a cost-to-income ratio of around 80%. Net interest margins, about average for a tier one, in fact slightly below perhaps at about just over 6%. So, ROEs of 5 is significantly weaker than, GT released 18, Zenith 10. So, the costs for the Pan-African business and just the general sluggishness domestically, we think are feeding through into weaker ROEs for UBA. So we're tepid, but admittedly the valuation is cheap, relative to other tier one guys, and we think investors are starting to have another look purely on that basis.